Hey everybody, and welcome back to H Invests. So we all have a bit of passive income, right? Getting paid a proportion of the company's profits, whose shares you own in the stock market, through the form of dividends. There are thousands of companies in the stock market that pay dividends all over the world. How do we know which dividends are sustainable and are actually going to generate you passive income in the long run? So here you can see, this is just the US market actually, and it's sorted by total yield. And you can see there are some crazy high dividend yielders actually, a few over 20%. But are these really sustainable? Like if we click on one, you can see forecast yield is 13.5%, and you can see a massive share price decline. So there's probably something significantly wrong going on with that company. So what we're going to look at today is we're going to look at one of my quality dividend filters that I use to really separate the wheat from the chaff when it comes to finding quality dividend companies. Let's get into it. Okay, so this is what the filter looks like. I've built this on SharePad, which is a bit of software that I use. It costs me about £300 a year, but to be honest, when you're looking at investments every day, that is really worth it. There are actually quite a lot of platforms you can do this for free. TradingView was one that I came across the other day. You can build filters. I think on tradingview.com it's called the screener, but I'll put that link in the description. So this is the filter that I use for finding really high quality dividend investments, and it's quite strict. It will usually only screen out the top 1% of companies in any given index. So you can go a little bit more risky than this, but this is for investments for the safe part of my portfolio, where I definitely want some passive income to be coming in, preferably with a relatively high yield. So let's look at the characteristics of the filter. So first thing I want to look at is over the past 3 years, has the company been growing their dividends, which is this second column here, sorry, the second row here. And then obviously this one is how much has the dividend been growing annualized per year. So I put a minimum of 3%. It's not necessarily my criteria to have the dividends growing at an incredibly fast rate, but I want to see 3% as a minimum because I want to see management at least committed to that growth. You know, if it's a very high yielding company, I'm obviously fine with 3% dividend growth every year. If it's a low yielding company, you know, at 2% or 2.5%, I would want to see much faster dividend growth compared to the yield, right? For me to want to invest in that company from an income perspective. Next one, free cash flow dividend cover. So for any given year, I would want to see this above 1. This is basically looking at how many times the total cash flow covers the total dividends going forward. So you want this to be at least 1, right? Because otherwise the company is using all its free cash flow plus some extra, you know, as either using cash or even worse, borrowing money to then get cash to then pay that out as dividends. You don't want that to be the situation. And I say 1 and not higher because, hey, the company might have had a bad year in terms of its free cash flow, but I want the kind of longer run average to be at least 1.2 to give me that margin of safety so that the company can, you know, use its free cash flow for other things other than just dividends, right? And again, if it's a high yielding company, you know, I don't mind a free cash flow dividend cover of 1.2 or 1.3. But if it's a company that's lower yielding and growing faster and I want to see a faster dividend growth, obviously this free cash flow dividend cover has to be a lot higher to compensate for that lower yield that we're getting today. Another thing is turnover. So I put -5 annualized, and then also for free cash flow, an average of a 5 yearly % decline is the lowest decline that I'm going to accept. Reason being is that, like, you don't really need the company, you know, particularly if they're paying a high yield, to be aggressively growing, but at the same time you don't want the company to be in dire straits. And if the free cash flow and the turnover is at least stable, then the company is not in dire straits. So that is something that I look at. So here we've got valuation. I like to invest in companies that are well valued, particularly when I'm prioritizing high yielding companies. You don't want to be investing in companies with ridiculous multiples, particularly when you're looking at multiples of free cash flow, because that goes directly in junction with obviously their dividend being covered by free cash flow. If they're yielding 4% in dividends, then they want to have they want to be trading at less than 25 times their cash flow at least, just to be able to pay out that dividend. So you want to be looking at low multiples. Again, now these next three are all quality metrics. So EBIT margin, that suggests high quality business, able to not have that many expenses and to actually get that revenue down to operating profit. Be very, very efficient at doing that. And cash flow return on capital invested. So the free cash flow the free cash flow return as a percentage of capital employed in the business, and also return on capital employed, which is looking at the EBIT as a percentage of return on capital employed. The reason that I like these in terms of the dividend investing is when these are high, it's a really good way to quantify whether the company has an economic moat. It's a really, really good indicator. So if the company has an economic moat, obviously that's competitive advantage, and that means that they're likely to retain their market share, retain the turnover and the profit that they're making, and to be able to consistently pay out these high dividends into the future. So that's one thing that I look at for these high yielding companies. And then net debt to free cash flow. So this is a very important one. So this is looking at how many years it will take for the company to pay off its debt with its cash, because of course it's net debt, and free cash flow. You don't want a company that is incredibly leveraged, particularly obviously you've got to pay interest on that debt, and that is just going to be something that eats into the company's operating cash flow and ultimately the amount of dividends that it can pay you. So that is something that I look at. And also I've got interest cover on here. I don't have a specific number for interest cover, just because of the way that this filter works is that sometimes if a company hasn't got any debt, if I put in a maximum value of here, it then won't show the companies that aren't paying any interest on their debt at the moment, which is not what I want, because if the company isn't paying any interest on its debt at all, that is okay for me. It's just I don't want their interest cover to be so low that their interest payments are eating into their bottom line. And then it's also important to look at the forecast. Again, I don't have necessary minimum for this, partially as well because if it's a really small company, it might not come up with a forecasting figure, right? If you've got a company with a market cap of 1 billion or sometimes even less than that, analysts won't often be predicting these forecasts just because there's not that demand from the buy side to see analyst forecasts, right? So that is something that I will obviously look at in my screener, but there won't be a minimum requirement, just in case the market cap of the company is too small, that the screener will miss it because there's not analysts actively forecasting it. So now what we can do is if we go on here to US shares, and then, yeah, here we go, we're filtered and we are sorted by highest yield. So we've got 57 matches. So out of about 5,000 companies in the total US market, that's consistent with what I said. The filter is getting kind of a top 1% of companies or about the top 2% of companies that pay dividends. And you can see the filter has actually got some relatively high yielding companies. We've got a REIT here paying 7.7%. The filter is suggesting that that's pretty sustainable. We've got Ultra, the tobacco company, which I'm still actively invested in. That makes up a relatively large part of my portfolio. We've got Hess Midstream Partners. I'm going to be doing a video on them actually. They're really interesting, kind of like midstream oil refinery, connecting people that source and drill oil to the people that actually go out and sell it. They kind of refine the oil and make sure it's all ready. So that's basically what we've got. I'm just seeing if we've got a market cap option on here. I don't think we do, so I'm just going to add a column so we can actually see the size of it, because one thing that's really interesting about Hess, let me just move that market cap. Yeah, one thing that's really interesting about Hess is that their market cap is really small. Oh, come on. Deselect. Yeah, there we go. One thing about Hess is that their market cap is really, really small. And, you know, not always, but there's often much less competition for those shares because you've got these massive, massive pension funds looking for income, investing in some of these other shares that might not be able to invest in Hess just because of liquidity constraints. So yeah, you've got a lot of interesting companies on here. Lockheed Martin are one bit further down. That's a company that I've been invested in for quite a long time. Western Union, they're pretty high yield actually. For a well-established business, for a 4.6% yield is quite impressive. So they're certainly one that I'm going to be looking at in the future. So yeah, that's basically it. That's how I kind of filter for my high quality dividend companies. Of course, you can build filters that are less strict with this, you know, and they will give you more results. But this filter, I think it's strict enough to really separate the wheat from the chaff and only give you the high quality companies. But it's not too strict that it, you know, just boils down to 1 or 2 companies which are only giving you like 2% yield. Like there are some quality dividend companies in here that are yielding pretty high results, you know, and for the most part they've been growing their dividends, and for many of them, management are forecasting good dividend raises in the future. So that was how I filter for dividends. I'm definitely going to be covering this a lot more in the future, so stay tuned. I hope you guys enjoy the rest of your day, and I'll see you in my next video. Thanks for watching.